following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
And welcome back to the Option Block. No, this is not the low melodic voice of Mark Longo. This is the high, irritating voice of Mark Sebastian. And boy, what a show we got for you. We got a real special show. We're going to do kind of a special theme show today. We're going to do kind of our normal trading block, and then we're just going to do mail after mail after mail, and then we'll get around to around the block. But before we get on with that part, let's introduce the panel. And with me is the largest by shoulder width of all of the panelists on this show, Mike Tusaw. Welcome, Mike Tusaw.
Good to be here. I've yet to have been complimented on my large shoulder width on this show, so I feel honored to say the least.
Hey, you know, if the Wall Street Bridge ever collapses, I think they'll just call you into duty and have you put your arms up on either side of the Chicago River, so the cars can get past. And also joining me is the cream of the crop from OX, Alex Jacobson.
It's gotten strange early in the show today, but good to be here, everyone.
Well, that's how you can tell it's me hosting and not Longo. But with that, let's move out of the pleasantries and into the trading block.
The Trading Block.
And here we are at the trading block, and well, another down day in the market, another kind of interesting day in the treasuries, and another rally in the VIX. Alex, what were you looking at today?
Well, we were looking at the 10-year and the 30-year, and obviously they're both bumping up against levels we haven't seen in a long, long time. The 10 is bumping up at 290, but 3 is really what everyone's looking at. And the 30-year is bumping at the 390, but again, 4 is what everyone's looking at. When I did my survey of the desks today, they didn't have any names that were lighting up the phones enough to get any, unusual attention. Apple and Tesla have been kind of a constant up here. We're also starting to hear a lot of hedging, a lot of put buying going on in the IWM and spiders. And obviously we were weak into the close, and the phones got active in the last few minutes. But on a relative basis, it was a fairly quiet down day.
Yeah, I was in the VIX pit, and it was dead in there. I feel like after the June scare, a lot of people saw some of the writing on the wall, and that's part of the reason why we're not seeing the same volume uptick in the 10-year note, and the same kind of pop in the VIX that we saw in June, despite a kind of a similar sell-off. Mike, I don't know, what were you noticing anything like that today? I mean, are your guys more hedged now than they were in June?
Well, what I've been doing for the time being, I hate to say I was forced to get back in late July, but when we were starting to make new all-time, I pulled the plug on a lot of things in late June. Just because of the fact that we started going down lower below where my long strike price was on my diagonal spread. And I just pulled people out. And then when we started getting back in, we got back in at we didn't really lose that much on the way up, getting back in because of the fact that some time decay had come out and vol had come out. So we actually got long again on, I believe it was the 19th of July. Now, since then, we've been kind of choppy and we've come down a little bit this last week or so. But what I've really held firm to the fact that I've wanted to sell near the money premium this whole time. And it's proven to be very beneficial because of the fact that what's been going on is that markets come down a little bit over the course of the last month, as we know. But what's really been benefiting us, especially from on the weekly option side, which is what we've been selling recently, we're noticing we're getting more premium every week now because of the fact that we have a VIX above 15. So it's kind of interesting with what we're doing in that we're being very cautious at this point. But let's say the market is to go up, then I hate to say the word banking, but we're looking to see the VIX come down if the market goes back up, and we won't get hit too badly on the short calls on the way up.
Yeah, it's interesting, but, just with this wicked move in the 10-year, and it's been pretty wicked. I mean, another, almost a 0.6 of a change in yield. The 10-year notes really getting aggressively sold. We're not seeing that big reaction in the VIX. By this time, off 70 some odd points in June, the VIX was already threatening near 20. And we were seeing volumes in the 10-year note near 2.5, near 2 million contracts. Today, despite the big move, only 1 million contracts a little over 1 million in the 10-year note, about, I'm looking at the 30-year. Where is the 30-year? Another 600,000 in the 5-year. So nothing really crazy. And, we did see that VIX finally get kind of a bit at the end of the day, but for I think how big this FOMC meeting is on Wednesday, not the meeting, the minutes, for how important I think they are, I would have thought there was more reaction. And even more so, Alex, I don't know how much you pay attention to the VIX futures, but those barely moved with the VIX today.
What did pop today was the 10-year VIX, that new benchmark that the CBOE calculates, the VXTYN. It moved 6% and took out 8%. And an 8% volatility on the 10-year is, to my recollection, not something that we've experienced for
3 years.
We're not talking a year or two now. We're talking some years.
I want to say that the last time 10-year vol was around 8% was somewhere around October, November of 2010, maybe 2011. But it's been a while. What a lot of people don't know, Alex, you probably can speak to this, but in the long run, is 8% vol on the 10-year low, high, or kind of middle ground?
Well, again, it's a really good question because it depends on kind of where you pick your number. But given recent history, an 8% is very, very high. I mean, realized vol in the 10-year has been big. Realized vol, I mean, we've had some, 20 days, some 30 days. But an 8% implied is the high end of the range. I mean, for most of last year, you lived with a 4 in the 10-year, and kind of nobody cared. Growing up in the early days of my career, 8% was not uncommon, but I would I just don't have the number in front of me. I would bet in the last decade or so, or to your point, in the last 3 or 4 years, 8% is up there and might be a near-term high.
I would agree with you 100%. But, over the long run, 8% actually tends to be, that's probably the lower end of the long-term mean of what that index will end up doing once they put out all the data. One of the problems with that index, it's a great index and a great calculation, but when the SIBO came out with it, they didn't release any data before the beginning of 2013. So it's not a lot of good until you really get all that data. But I would bet you in the 80s and the 90s, when there were some actual teeth to interest rates and we didn't have this kind of Fed intervention, that 8% would have been at the low end.
Well, when we introduced the interest rate options at the SIBO, the second version of interest rate options, I remember vol back then was probably in the 7 or 8 on the 10-year. The products themselves didn't trade that much, but it was nice to have a vol picture so that you could get kind of a benchmark of it. I mean, we moved almost a full 0.5% in vol today. That's a big move in something as liquid as the 10-year.
Yes, absolutely. So, just if I was going to sum up anything, and stop me if you disagree, Alex, but the dog that is wagging everybody's tail is this 10-year Treasury.
Yeah, no question. It's the 10-year. The curious thing, and this is maybe an Options Express issue more than anything else, but when I surveyed the desk this morning, on the day of the show, I survey the desk a couple times a day, and I go like, what's lighting up the phones? And when I surveyed the desk this morning, we had an extraordinarily high level of new account activity. And I know there are a lot of people who think account opening and market performance are contrary indicators, that lots of new accounts means the public's coming back in, the public's coming back in means, possible market top. I don't necessarily agree with that metric, but we've had an enormous amount of new account activity in the last couple weeks and days. And I'm trying to get a sense of what that means, and I'm simply not sure. I'm going to wait and look at some trading statistics out of the new stuff. And obviously, just because people open doesn't mean they trade right away. But the appetite to opening is unusual, and I'm trying to get a better feel for what that means. Mike, in your experience, when you see a lot of new account opening, is that a precursor to something?
Well, I thought it was more of a lagging indicator, because when we used to do analyses and we used to analyze that quite a bit actually in the marketing team meetings. And from what I remember of it, what we used to do was, in a bull market, we would get more accounts, but it would typically follow the bull market, from my best recollection. Where I think the game's changed a bunch, that was before Schwab bought Options Express. Where this could be different right now is that I would imagine with a lot of your traditional Schwab-type clients that might be looking to possibly hedge their accounts, Schwab, when someone wants to open an options account, I would imagine would definitely push them to Options Express in one way, shape, or form. So this might be someone looking to hedge. To add to that, right now we do have a more sophisticated retail investor now than we did 5 years ago. So for the new account activity, I'm curious to see what that comes out to myself, because I think years and years ago, I always felt it was kind of a lagging bull market, meaning signal a top, but the new accounts would come on board after the bull market had started.
Interesting. Well, I'll report back because we know more.
Yeah. Well, my theory is that the growth, the exponential growth is directly tied to the exponential growth of the ratings of the Option Block podcast. That's my theory, but that's just me. And with that, we will close the trading block and move right into listener mail block.
Now it's time to empty the mailbag. and see what our listeners have to say. It's the Mail Block.
That's right, folks. Like I said, we're going to do a special listener mail show. And so we're just going to kind of start hitting some questions. This one is from Lee Patterson. I've been an Option Block listener for a few months, and you've inspired me to hedge my retirement plan through my employer. It's been 100% invested in the S&P 500, and fortunately, I cannot use options in this account. My idea is to go to cash in my retirement plan at work while buying 3-month at-the-money calls in SPY and rolling them when they are 1 month from expiration in my Roth. To finance these, I would sell the weekly SPY about 2 to 3% out of the money. Does this seem like a reasonable plan to participate in the upside while limiting losses, or is there a better way? Thanks for your time. Lee. Mike, I'll throw this one out to you.
All right. This is one where this is a very, very, very big part of what I spend my entire day doing is exactly what you described, Lee, just kind of along a different area. One thing with your retirement account, Lee, what you may want to do is from a long-term investment standpoint, see what type of bond funds are in your retirement account. And if you are a bond person, if you want to have some type of long-term bond exposure, that might be a spot to actually do it within your retirement account, whether there's some type of treasuries or something along the lines to where you have it to where maybe you can invest in something that you have the ability to hold till maturity. I'm not sure, but something to investigate. Or perhaps you have the ability to do something along the lines of precious metals. I don't know. But I don't know if cash is necessarily the ideal option, but it all depends on what your choices are. Now, in terms of actually participating in the upside of the market, I love what you're doing. I think it's a great way of doing it. I think that putting a smaller amount of your money into call options instead of a larger amount of money into a fund, I think is a very prudent financial way of doing things. It's what I've based my whole career on in a lot of ways. Now, in terms of the actual time frames that you're using, a 3-month call and rolling at 1 month to expiration, I prefer going about 6 months out personally. Not exactly 6, but around that area. And what I'm basing that on is there's an article that was done, you can actually do a Google search for it, Collaring the Cubes. And what it is it talks about a collar strategy that the University of Massachusetts did in terms of doing a collar on QQQ. And they base it on, and there's a ton of statistical data in there, but what they base is one of the most efficient ways to create time decay in your favor, not necessarily in your favor, but to kind of hedge it, is to use about a 6-month option on the put side and then sell 1 month call options. Now, this is before the multiple week weeklies were done, but with that in mind, what I like to do is go 6 months out on my call option because of that data that was in that study. Now, in recent times, what I've been doing over the course of the last 7 or 8 months, I'm not against doing a monthly short call option, but I've really evolved a lot. The fact that I'm trying to get every ounce of theta that I can, so to speak, but because of the fact that now we have 1 week, 2 week, 3 week, 4 week, 5 week options, if the option goes a little bit against me, or if I'm wrong, which I am wrong at times, we all are as humans, then I have the ability to roll from a 1 week to a 2 week if I need to, or a 2 week to a 3 week, whatever the case may be. So love what you're doing, except I would recommend possibly going out a little bit further with the long option and in a little bit closer with the near-term option.
Well, there you have it. And, one thing I would look into on the retirement side is they do have some of these interesting mutual funds and different structured products that, like you said, that maybe have a hedging component to it. There is a SIBO benchmark index that does a VIX future and a SPY combined. I forget what that's called. There are some unique products out there if you really want to make sure you're hedged. Alex, do you have anything to add to this guy's question?
Yeah, I think absolutely. I think what Mike talked about is spot on, a longer hedge, but there's also a tax issue here. And I think when you're in a retirement account that can't hedge, the idea of taking the retirement account to cash let's talk about the mindset for a minute. When are you most upset by the fact that you've hedged? And that's when you don't need it, right? When are you most unhappy with car insurance? When you write that check every year and you look at it. I once had to do a remedy class for a group of financial advisors in Arizona who had, in fact, told the customer they couldn't hedge a mutual fund. Now, I understand you can hedge in that account, but let's think about this for a minute. Leave the retirement account intact. Buy some SPX puts in a cash account. Why SPX over Spider? 60-40 tax treatment. But buy some SPX puts in a cash account, and let's play out 3 scenarios. Scenario number 1, the market goes up. You didn't need to hedge. If you'd gone to cash, you would have, to Mike's point, underperformed. There is significant risk in cash. If you're a portfolio manager, you've been in cash for the last year, you are currently unemployed. So there is risk in cash. And the reason I like hedging in a cash account is if the expire worthless, you're going to get paid part of it back by the government with the tax loss. Yes, I know you can only carry a $3,000 tax loss forward, but in the cash account. The challenge to hedging in the cash account is obviously if the market goes down, you're going to have a 60-40 gain. You're going to give some of it back in taxes, but you're not going to be out of the market. And if you're fundamentally a long-term investor, the hiccups you get occasionally, I mean, if you've sat in the S&P for the last decade and reinvested the dividends, you've made about 7% a year. Now, before I throw the big asterisk up, a lot of that came in the last 17 and 18 months. I understand that. But I would rather see you hedge in a cash account, and that way if you don't need the hedge and the hedges lose you money, about a third of the hedge you're going to get back from the federal government in the tax loss. So it's both a hedging question and a tax question. And to Mike's point, hedge longer term. And when you do hedge, if you do get a blip in the market and all of a sudden it's down 5 or 6% and the value of your hedge has doubled, don't rush to exit the hedge. Don't rush to exit the hedge. If you want to adjust the hedge, again, I know there are going to be tax considerations, but if you want to adjust the hedge and move the hedge down, take some profits, consider doing that. But I would not move the retirement account to cash. And the other thing I would do is I would talk to my employer about why aren't there more choices in the retirement plan that allow me to hedge.
That's all great points. Very good points. This one's an easy one. This is from on Twitter, @Matigia. Which direction is a risk reversal? Which is a short risk reversal? Descriptions conflict. Thanks. I always considered a collar and a risk reversal 2 different things. A collar is when you're long put, short call, and a risk reverse, long out of the money put, short out of the money call. And a risk reversal is when you are short and out of the money put and long and out of the money call. Thus, your risk is reversed on a long stock or on a you're basically it's a hedge against a short stock position. So that was the way I always considered them. So my opinion would be a short risk reversal is essentially the same thing as a collar. Is that always the way you understood it, Alex?
Spot on.
Thank you. Real
Same
easy.
here.
Yep, real easy one. Question from A. Jackson. Andrew referenced double butterflies on a recent episode of the Option Block. Can you explain a little more about the position, how it differs from a regular fly selection, etc.? Thank you very much, Mark, for making such an excellent options content freely available to everyone. Your network is certainly one of a kind. I'm glad to see it is doing so well. Yeah, that's a good one. So the reason why you do double butterflies versus kind of a standard butterfly, one, it's a skew trade. So you're trying to find the sweet spots of the skew curve. Now, a professional, to find if he's trading the sweet spots of a skew curve, he's probably just kind of setting up the trade there and doing it as he wants. So it might turn into things like strangles or different trades like that. areas of mispriced volatility because you get these butterflies at discount prices, and hopefully you can flip out of them. So is it different than a regular butterfly? No, it's just differently placed and a different way of kind of playing the vega and the skew curve as a whole in an attempt to kind of capture edge that a lot of the retail public isn't aware that they can actually try and capture, and that's what makes it so powerful. This one, our next question, this one's from Richard D. Hello. In this episode, there is a discussion on taking advantage of Tesla skew and using out-of-the-money Tesla butterflies on both sides of the strike. Similar to a double butterfly. Being used, could you explain a little more about skew and if long-short butterflies are best at given skew? Well, Andrew always likes to say skew is the market's guess at how accurate at-the-money volatilities are. Another way to look at it is it's where kind of supply and demand is structured and where a lot of risk is laid out. I think I just answered kind of the double butterfly question, but skew in the end, I think it is caused very much by kind of supply and demand issues. And in a name like Tesla, where there's a lot of people betting on a hard move up or a hard move down, it causes those wings to get way out of whack. And so what Andrew was trying to do is really come up with some smart ways of taking advantage of that. Alex, I mean, when you're asked to explain skew to somebody, how do you describe it?
Well, here, I'm going to throw the question back at you because you were a market maker. Talk a little bit about what a skew smile is, because I think that's the embedded answer. Okay.
Well, a skew smile, it starts with, it's really the relationship of puts, at-the-money options, and out-of-the-money option. It puts out-of-the-money, at-the-money options and calls. In equities, traditionally, and I always thought it was due to the collaring effect, puts trade at a premium to at-the-money options, and then calls trade at a discount to at-the-money options in terms of volatility. So, and the idea behind that is that you look at skew from kind of the hedger's perspective. For instance, in many of the commodities, you'll see kind of a forward skew because hedgers are more afraid of the underlying going up than they are the underlying going down. But in equities, think about it, the whole world is essentially terrified of the S&P 500 going down. I mean, there are so many, our one reader is not allowed to trade options, not allowed to be short. CalPERS won't short. So you've got this whole world that is long equities in pension funds, 401ks, IRAs, regular accounts. And so the whole world hedges these equities by buying out-of-the-money puts and then paying for that by selling out-of-the-money calls. And it creates this, and thus creating a smile. Now, in a name like Tesla, where you have people making crazy bets on whether Tesla goes up, Tesla goes down, you'll see that call side where people are reaching, trying to make big money on a big Tesla rally. You'll see that call end of the curve start to lift and match the put side of the curve. That'll turn into a full smile. There's other explanations for smile. Some will point toward Taleb and his black swan and the fact that, when one of the areas where the pricing model falls apart is that typically when a market moves 3 standard deviations down, it's going to move 4, 5, or 6. And so those probabilities are not 100% accurate in some of the way out of the money options. So, those are kind of the major reasons why I always thought skew existed and really what it is.
I think that's a good explanation. I think we could do a whole show on skew, which we shouldn't do because
yes,
it will hurt our numbers. But I will tell you an interesting observation. skew didn't exist much prior to the 87 market crash, and is a measure of how dangerous it is to purely delta hedge. And that's why you see it to an extreme degree in out-of-the-money options. And it's become so systemic in the industry post-87 that with so much automated market making, you would think that different market makers would have different skews. But it is not uncommon to come in at 8:30 in the morning Chicago time, just as the markets are opening and I don't know a good term for it, the machines are being turned on, and you will find that multiple market makers across multiple exchanges have almost the identical skew. And you say, why? And you say, because they're watching the same flow of customer paper. But it's a much longer explanation, but I think your explanation of it, Mark, was terrific.
Well, thank you. I appreciate that.
So let me ask, to kind of add to that, Alex. So before 1987, then apparently put options were not used that much by bigger money people as a hedge. Was there a lot more people just hedging by selling covered calls and viewing that as a hedge, even though it's not a true hedge?
No. But what you had prior to the 87 crash was not that there wasn't a lot of put buying. There was an enormous amount of natural put selling.
Got it.
Remember, LOR, Leland O'Brien and Rubinstein, the people who brought you the end of the world in 1987, were dynamically hedging by recreating a put. So you had lots of delta hedging. Typical market maker on the floor of the CBOE sold puts against calls, went home delta neutral with phenomenal amounts of gamma risk, right? But they didn't worry about it because you didn't get these big gaps. And when you did get a big gap, it generally wasn't in the market. It was in an individual equity name, and the company would be taken under or taken over, and you'd get hurt by that day. But if you're a market maker, you made the money up in the next month. But prior to the 87 crash, hedging was get delta neutral and don't worry about a 2 standard deviation event. Mark's point that when it goes down, it's a 6 or 7 standard deviation event. I don't want to create controversy. There is no such thing as a 6 standard deviation event, okay? It doesn't exist. It means that our benchmarks are wrong. And you'll have people who say the 87 crash, there was a math guy on the floor who was a former professor there was one who was at Brown, and there was one, I think, who was head of the math department at MIT. And I made the comment at a presentation that by traditional measures, 87 was a 22 standard deviation event. And he did exactly what Don Schlesinger always used to do. He would get up and dope slap me in the back of the head and say, there are no 22 standard deviation events. Your metrics are wrong. And that's when you realize that things like the Black-Scholes and the Cox-Ross make a lot of assumptions about continuous pricing and ranges of trading. And when it pukes, it pukes. Yeah. And to turn around and say, well, this was statistically impossible. The guy's name was Mike Razar, and he was a brilliant OEX market maker. Lots of great stories. But what he said to me was the Pentagon had done statistics of what the probability was of the Russians coming over the Berlin Wall with tanks and troops. And statistically, that was more likely than October 87. And he said, what that proved is not that it was more likely, it proved that our metrics are wrong.
Yeah, I don't think that's that controversial, and I think that makes sense. And I think that you could sum up then what you just said and skew is the market's way of trying to make up for the fact that the model is imperfect.
Yeah, and it's market makers. This is the one thing I say that always gets me in a heap of controversy. It's market maker delta and gamma in and out of their portfolios cheaper than just trading the spot. Now, what do I mean by that? Let's do a quick black and white example. It's a minute before 3, and the Google market maker or the Tesla market maker or the Apple market maker does a trade where all of a sudden he's got to adjust and lose 10,000 delta. And you say, well, that's simple to adjust. He just sells 10,000 shares of Tesla, or he sells 10,000 shares of Google, and that takes him out of 10,000 delta. And you say, well, let's wait a minute. The Google market maker might have 5 million Google delta. And if he sells 10,000 shares, he moves the value down on his 5 million. And that's a horribly expensive way for him to get rid of his 10,000 delta. He'd rather skew his options and try to create the right combination of people who are going to trade puts and calls to take the 10,000 delta out of his portfolio, understanding that sometimes it won't work, right? Sometimes it won't work.
Yeah.
But I think it's actually the liquidity provider community trying to get the marketplace to help them create the hedges that they need, with the understanding that it won't work. You got a hedge at 3 minutes before 3, and you're in Tesla, Intuitive Surgical, or Google. You'd rather skew the options than begin dumping stock, because if you knock it down $4, $5, $6, and on 5 million delta, you just repriced your inventory down $25 million, and that's your last day of work.
Right, for sure. Well, now that we're fully into the weeds, I think it's time for us to cut out of this jungle and move into Around the Block.
Around the Block.
All right, and welcome to Around the Block. Mike, what are you watching going ahead?
Well, just in general, want to see what the Fed minutes are going to be coming up. Also watching some pretty key numbers in the treasuries with the 3% mark on the 10-year note, amongst other things. But for the most part, just seeing what the Fed has to say next time. And it seems like that's pretty much what moves our market these days.
Yep, that FOMC, I think, is the key stat. Alex, is there anything else on your radar?
No, Tucson, spot on. That's what we're looking at, the 10, the 30, and Washington. And we're going into a cycle where there's going to be a lot of news potentially coming out of Washington, and we'll see how dysfunctional they are, or if they figure it out for everything they've got to do in September.
Yep, I think we're going to get through these FOMC minutes. You'll probably see the bond market calm down, and then we'll move from there. Part of the reason why the bond market's moving is because guys are hedging all these interest rate sensitive options ahead of the Fed, just in case the floor does fall out. And these FOMC minutes, I think, are going to matter. So I think they come out 1 o'clock Central Time on Wednesday. That'll be a key time. Alex, what's going on at Options Express?
The next two events, big event next Saturday in Boston, a live event, an all-day with Jimmy Rouzan, old contemporary of yours, Mark, market maker, buddy of yours who does our outreach education. So an all-day Saturday in Boston. That's a free event. One other event I'll showcase is because we've talked about the kind of rate of new account opening on Wednesday. At noon, we're doing a new customer event showcasing how to trade futures. As we've all talked about on recent shows, the growth in futures and futures options has just been phenomenal in the last 12 to 15 months.
Okay. Tusa, what's going on with you?
Couple things. This Thursday night, we thought it was going to be last Thursday night, but we had to do some schedule juggling. This Thursday night, Mike Kavanaugh is going to be discussing a CTA fund with which we're partnering. We don't have an exact date yet, but we are speaking with someone, and we have a handshake deal that he's going to do it. We're going to have a webinar on Obamacare, what you need to know about it with your finances.
All right. Wow. And in terms of Option Pit, I have a webinar for the CBOE on Thursday, and my next VIX class in conjunction with CBO and TheStreet.com is going to be Saturday, September 28th. Look for the sign-up to be up shortly. Again, as with all, for new incoming students, I will credit the amount you pay against any of my coursework, gold or platinum or higher. So absolutely worth attending, and a really good course. So with that, we're going to call this one a fun, short show, and we hope you had a great time, folks, and we will see you next time on The Option Block.
Become a part of The Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting, and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.